Taoufik Gharib. I'm a credit analyst at Standard & Poor's, and I have the privilege to be moderating the panel over the next 60 minutes. Before I do so, let me introduce our panelists. On my left is Jeremy Pinchin, Chief Executive Officer of Hiscox Re. So his left is Don Kramer, Chairman and CEO of ILS Capital Management. To his left is Costas Miranthis, President and Chief Executive Officer of PartnerRe. And last but not least is Arthur Wightman, who's the head of PwC Bermuda and also the insurance practice. I will leave about 10 minutes towards the end of the panel, so you can ask questions from our esteemed panelists. If you can refer to the bios of our panelists in the conference book that it's available on your tables. Before I start, in terms of the reinsurance environment currently, it seems that is somewhat familiar with the one we experienced back in the 90s. One, there's overcapacity in the market. Two, you have low cat losses. Three, there is pricing now declining. So in terms of we try to compare and contrast the current market versus what we experienced back in the late 90s, are these markets similar or are they fundamentally different? So maybe I'll start with Don, give us some further perspective.
Thank you. I'd like to make a comment because Stephen Catlin was here. He said he started in '73. In 1973, this is absolutely true, I was about 100 feet from here, starting my first reinsurance company. I was in name at Lloyd's, and in those days we had unlimited liability. I was a member of the New York Stock Exchange. We had unlimited liability there too. I was in Murray Lawrence's syndicate, and we started a reinsurance company. We defined the term naive capacity. At the time, I was with Oppenheimer and Company, and we had one of the best performing mutual funds. Oppenheimer and Dreyfus were 1 and 2. And so we figured if we could start a reinsurance company with our mutual fund performance, we'll just make a fortune. We'll write $2 a premium for $1 a surplus. That'll give us $3 to invest. We had a 15% return. It'll be sensational. We'll make 45%, and we'll break even. So we gave our pen to Alexander & Alexander. And a few months later, I get a little note that said, kindly favor us with your remittance. I said, what's this? He said, well, that's a claim. I said, but on what? Oh, we don't get the wording till next year. So we defined the term naive capacity. We closed the company within a year. And I remember that. And it was in the year 2000 that David Ezekiel called me and said, by the way, we liquidated your company. So that's the reinsurance company industry I grew up in. And of course, the current industry clearly is going through an interesting change as well, because massive amounts of money have poured in. We have not had low interest rates like this since the end of World War II. Rates in World War II were pegged at 1.8%. Today, Treasury bonds are the lowest they've been. So for the insurance industry, the buyers of reinsurance, they found that they get lower prices, so you'd think, well, they'll buy more. To the contrary. What's happening is because their investment income is declining so sharply, they're actually taking more risk. And for the first time, we watched demand, which I thought was inelastic. We've watched demand for reinsurance decline significantly as companies retain more risk to make up for the loss of investment income. The third thing, and everybody's so aware of it, is that the investment community now, institutional investments, from where it was in 1973 is staggering. It's multiple times, probably over 30, 40, 50 times the size of the reinsurance industry. And they're having yield issues as well, and so money's poured into the industry. And as it has, clearly it's lowered prices. And you've had two issues. One, of course, is reinsurance itself, looking for people to use it as an alternative investment. And the second, which is much smaller and interesting, is the hedge fund movement into the island. Hedge funds, when I grew up, were long and short. Now they have all kinds of complex strategies. But that industry has also come in and they've looked. So we've had the softest market we've seen. And I think Stephen said it correctly. It's as soft as you think the market is. In terms of risk, last year was an outstanding year. And prices, while they're down, are not down anywhere near their absolute lows. What we do see, however, is a change, and I think it's affecting the reinsurance brokers, because what we're seeing now is a lot of other insurance-linked securities and other kinds of things that are going around the brokerage market. So those are some of the conditions, and we're waiting for interest rates to change, but as far as I can see, inflation in the world is very low, and I don't see at this point an increase in rise in interest rates. And the last thing is that the leverage of the industry has diminished dramatically. When I was originally an analyst way back in those days, Chubb had $2 of premium for $1 of surplus. And so that gave them $3 invested assets. Well, if they earned 7%, they were earning 21%. If they broke even on underwriting, they were showing a 21% return on equity. Today, Chubb's probably around 0.8 or 0.9, and the yield on its portfolio was declining rapidly. So you can see there's massive changes in the entire institutional market, and it's coming forward. But it doesn't mean the market's over. It doesn't mean people don't have to buy reinsurance. It just means we're going through an interesting period, and it requires a lot more analytics, and I think everybody agrees on that, than it's had before, as to diversification and as to portfolio analysts in terms of where you write.
Thank you, Don, for that historical perspective. Appreciate that. Costas, from your perspective, in terms of the comparison between the 90s and the current market?
Well, I think Don covered pretty exhaustively all the macro factors. I don't think I have a lot to add there for sure. The availability of capital, the pools of capital available from the capital markets are a different order of magnitude than they were back then. We're dealing with a very, very different macroeconomic environment, especially low interest rates and relatively low inflation rate, which has been a surprise in contrast to the late 90s. But rather than repeat the same arguments, because I think the analysis was very good there, I'll give you a couple of observations about the structure of the market, the structure of the reinsurance market. I think the reinsurance market today is far more sophisticated than it was in the late 90s. In the late 90s, Don referred to it as naive capacity. It may have been naive, it may have been not particularly professional. And although today you find some reckless players, it's very difficult to find somebody who is completely irresponsible today. People have models, they have access to better skills. Frankly, the quality of the human capital in the industry has improved enormously over the last 15 years or so. So some of the excesses and some of the stupid behavior that you may have seen 15 years ago, I don't believe it's around today. So that's a change, and it's a change for the better. The second is, I think the degree of transparency has improved. 15 years ago, 20 years ago, a lot of the reinsurance capacity was coming from divisions of bigger organizations. A lot of them, a lot of the economics of the reinsurance industry, in particular, were not particularly transparent to the equity investor. That has changed dramatically over the last 10 years, particularly as capital has been moving to set up new companies here in Bermuda. Couple that with the raised standards of disclosure, and you have an industry where it's very difficult to hide your head in the sand and not face the truth for any sustained period of time. So those two things, I think, are better. So the industry is better equipped to deal with tough times, and it can't turn away from the truth. We have to face the music and dance.
Thank you. Jeremy, you think the industry currently is different in terms from, let's say, historical levels?
Well, look, I maybe have the least reinsurance experience of my two colleagues on the left, but I've been in the insurance and reinsurance industry all my career, and having seen and living through these changes, they're quite dramatic, and it's always deepest and darkest when you get to the middle of the cycle. And it's always very difficult at that time to really tell what is truly a long-term change and what is a short-term imbalance. You know, I'm reminded as we're sitting here in Classic Rugby Week that I sat down on Saturday morning with my daughter when she was meant to be playing football to watch rugby, as it's a great passion of ours. And I'm sure a lot of you maybe for American side don't understand rugby, but after 4 minutes, we scored a try and I thought we were going to win. By half time, I thought the cycle was going to change forever, that we were going to start to be on balance with New Zealand and start to win some games. And by the end of the game, we'd been trounced and we'd gone back to the original cycle. So I think what I'm trying to get across in that message is that it's very difficult mid-cycle to really call it one way or the other. Do I think there's a fundamental change? Yes, I think the fundamental change we've got is we've got access to new capital set up and mechanisms for it that are set up that we can't go back from. How far that goes, how systemically that changes matters, I don't think I can tell. But certainly as a reinsurance organization, we're used to serving different capacity providers, and we are setting up to enable us to do that. But I think that halfway through the cycle, when we've seen a pretty benign loss scenario, particularly in the US for the last 6 years, where we've seen pricing driven down, and I slightly disagree, which I say with great respect with Stephen's view that pricing is as good as ever. I think that our understanding and our professionalism of pricing of risk has changed somewhat since the 90s. And I think our understanding of some of those factors have changed by dint of some of the events we've had. I do think we are getting close to some difficulties in pricing. I do think that we have, because of the benign period and the great returns we've had, even despite reducing pricing and widening terms and conditions, lost touch with some of the fundamentals. The good pricing, good underwriting, pricing in terms and conditions is absolutely vital to the market. And I think we need to go through a broader and longer term period of the cycle to see the market fully tested, to see how systemic these changes are. There will be changes, but I think the full test needed to be here of actually what is the value and the true cost of our product. Because I think you lose a little bit of perspective when people come in and add capital to the market, we drive down prices, clients test the bottom, brokers do the job they're very good at pressing prices and widening terms and conditions. And sometimes, I don't think it's naive capacity, but I think they're not best served sometimes. There is still a view that it's other people's money, and it's slightly easier to make some pricing decisions in those circumstances. So, yes, I think there is a fundamental change with capital coming into the market. That will be with us, I think. It's another step of change, but I don't think I think it's too early to tell this stage whether it's a full change or not until we see some real tests of the marketplace with some big losses.
Thank you. Arthur, do you agree with some of the opinions that were expressed on the panel?
Absolutely. There's not a whole lot more I can add. I think the one area I would focus on that I do think is a difference, and it aligns to the point of being somewhat better equipped, but I think risk managers themselves are far more sophisticated. I think the insights that are shared right across the distribution chain, both from brokers as well as from reinsurers, to give a better understanding of the risks that are being insured, has really blossomed over at least the last decade, if not longer. And I think this places a bigger demand on the reinsurance market. Risk managers can understand better what they want to cede. They can be more strategic in what they want to buy, and so they really are driving the reinsurance market to find solutions that are far more creative and aligned to the portfolio of risk that they want to cede.
Thank you. Costas, in terms of, we talked about, some behavioral changes from the cedent's perspective. It seems that over the last few years, especially large cedents have now concentrated, the reinsurance purchasing at the holding company in terms of optimizing their portfolios and getting better pricing from the reinsurers. From your perspective, do you believe that, let's say, mid-sized companies to large, reinsurance companies with multiple offerings and global diversification, whether it's by geography or product, have maybe a competitive advantage in this market because of this change in behavior?
Well, whether they have an advantage or not depends on what strategy you're trying to pursue. But for sure, there is a differentiation in the minds of the clients. When a client buys a reinsurance, it looks at 2 or 3 things. First, can you be meaningful? Can you provide, do you matter to me as a reinsurance? And I would put it to you that having a slip with 0.5% lines or 1% lines and having 25, 30 reinsurance on a slip is neither efficient nor particularly valuable from the point of view of a client. So you will see, I think, concentration on the size of the panels in many reinsurance programs. It's obviously a question of degree, but this will remain largely a syndicated market. No reinsurer will be large enough to fill everything on its own. Does that mean that small reinsurers do not have a place? Absolutely not, but they will have to have a very different strategy in that kind of environment. Second, reinsurers that offer expertise are differentiated from reinsurers that are simply followers. And in a citizen's mind, working with somebody who can provide a creative solution, understand the problem, understand the risk, and understand the need for risk transfer and what the citizen is trying to achieve is very different, and they will behave very different towards that reinsurer from somebody who's merely there filling capacity. And third is about breadth. Reinsurers that are can only offer solutions in single lines of business will have a place, but will not be treated in the same way as reinsurers that can offer multiple solutions across many types of business. Does it mean that the smaller, more focused reinsurers don't have a place? No. If they do have a place, they just have to have a different strategy. And they will not have access to the same breadth of business as the bigger reinsurers, the reinsurers with broader capabilities. Where does it matter? I don't think it matters on the pricing. This is a syndicated market, and there's very little differential in the pricing. Just because you can offer better service or more capacity, it's very rare to see that you'll get differential terms. Where it does matter is on access to business and perhaps access to attractive business that may not be offered to a broader market, but only to a more limited panel of reinsurers.
Thanks. And Don, do you see some of the changes in terms of how the cedents are purchasing reinsurance these days?
Well, to some extent. One of the issues is counterparty concentration as opposed to counterparty risk. Before, we used to look at counterparty risk, but now you deal with companies that are rated. Lloyd's, for example, has its guarantee fund, and other companies have their ratings. So counterparty risk per se on individual accounts aren't that meaningful anymore, and there's so much compliance nowadays. It's not only expensive, but it's extensive. And so counterparty concentration is an issue that people focus on rather than counterparty risk. And they're saying, look, if I have one reinsurer, for example, in one case I remember a couple of years ago, was in trade credit where literally 60% of the business was with one account. And then they decided to go out of the business, and the cedent was really frustrated. So you want to have some difference of views and have counterparty. Second thing is, in the old days in Lloyd's, for example, you had a Lloyd's leader, and then you had followers. Well, today, you have to report your analytics to Lloyd's on everything you do. So even though you're following somebody, you have to go back and do it yourself to show Lloyd's that you did the same analytics that he did, rather than just being a follower. So we don't have leaders and followers that much anymore. But I think the issue, as I mentioned, is the issue of concentration. You don't want one reinsurer to represent your entire account. You need to have some diversification, because if they decide to, for some reason to pull out, you don't want to be hung.
Thanks. And Jeremy, do you see also some changes in terms of how you cedents are purchasing reinsurance?
Well, we sit as a mid-market player. At times, I'm very pleased not to be a player playing across all sizes, more commoditized, having to continue to write business, because it enables us to take a choice. As an insurance and reinsurance platform, we're prepared to move our capital across to the right lines of business for us, and that's what we've done. In a recent statement, we made it quite clear we're reducing our reinsurance lines and moving it into more profitable insurance lines. That's a facility we have because of the flexibility of the group, because you are feeling pressure, I think, at the top end to give broader covers. Even at the mid-levels, you're seeing the pressure on covers, as Stephen talked about, with cyber and terrorism and hours clauses, which is very important that are priced into and understood in the nature of the cover you give. I think the word you hear a lot now is the word relevance, and it's a word that is oft used and maybe oft abused, but relevance is absolutely critical, I think, to staying in the game with your cedents. It's about understanding the nature of the issues they have, producing products that start to solve their problems. It's about maintaining relationships, again, as Stephen said. It's about having leverage with the broking community to make sure that you see the right risks. And it's about having some balance to utilize those skills, but not be driven that you have to write across the whole marketplace, because I think that drives you to accepting risk that at the moment is being increasingly poorly rated. So the word relevance is very key, and many people are struggling to keep that. And I do think that we will see, maybe unlike my colleagues, I think there is some pressure on the smaller players, perhaps in the London market where commissions are higher and where the line sizes are smaller, of maintaining their positioning as we move into increased capacity in this marketplace.
Just to follow up on your answer, you mentioned that because of Hiscox has both platforms, insurance and reinsurance. Do you believe that because of that business model, it gives you more, let's say, of an option to go through this cycle because you can allocate capital where you think fits because of adequacy of pricing?
Well, look, there are many business models, and I'd be the last one to sit here and criticize anyone else's. I think it's something that we have worked on. We recognize in the big ticket market, both those insurance lines, big ticket insurance lines and reinsurance lines, our business model is very much set out about expanding and contracting according to market opportunity. Discipline and underwriting is absolutely core, and we have a growth of a brand in our retail business where we can move capital across. That's our business model. It works, I hope, for us, and it has traditionally done so. I hope it will continue to do so. And it's slightly different from many others that enables us to manage, I think, in very complex marketplaces.
Costas, just to follow up on your answer earlier, you mentioned that within reinsurance, it's a syndicated market, but we've been hearing from your peers and some of your larger peers that this market is tiered. You have tier 1 reinsurers and tier 2 reinsurers. So one, do you believe in that separation in the market? And two, if there is one, is there a differentiation in pricing if there is such a thing as tier 1 and tier 2 reinsurers?
Is it 2 tiers? Is it 3 tiers, 4 tiers? I don't like to characterize markets, but clearly in cedants' minds, different reinsurers are differentiated. Does it make a difference on price? I think I gave you my views on that earlier. I don't think it matters very much on the terms, conditions, and ultimate price that you get in syndicated products. There's very, very few examples that I can think that the price, certainly on the non-life reinsurance, the price that you get on a specific contract is different because you're a tier 1 or a strong or differently rated reinsurance. The price is by and large the same on all syndicated contracts. Where it does matter is access to business. If you're a reinsurer with different capabilities, or you can offer a different kind of service and solve different problems, you may be offered and you may see business that may be more attractive that others will not see. But on a particular contract, I don't think it matters.
Okay, great. Before I move to the next question, I would like also to go back to pricing. And maybe, Don, if you can give us your view on where pricing is heading prospectively, whether it's in prop cat or casualty lines.
Well, I think Stephen Catlin laid it out, and that pricing is down. And there's different levels. In the high-risk levels, you have one type of buyer. And in the lower risk levels or the more remote levels, you have a second level of buyer. So, for example, we've had the hedge fund invasion, if you want to call it that, where hedge funds said, look, I want to get in here, I want to write in reinsurance, but I don't want to write high-risk reinsurance because I'm going to take high risk on my portfolio. And then the others are looking and saying, well, I really want to write the long-tail business because I want the investment income. So there's been, both of those markets. But I just don't see significant change.
And Jeremy mentioned that we are in a tough environment when it comes to pricing. So let's say if you look at your crystal ball for 2015, what do you see?
Well, look, I think we're beginning to see it come in now. I'd love to sit here and deny the reality, but unfortunately that wouldn't do me much good. We did see some in the property cat world resistance to some of the further pricing pressure at 1.6 and 1.7, and that slight discipline at that time was welcome. I think we always recognize that even with a big event, because of the nature of the profitability we've seen in the industry over this year and in previous years, to change the dial takes more than a Sandy event to happen late on in the year. It takes multiple events to happen. That even despite an event happening this year, and we've got, 6-7 weeks to go until the year end, that we were not going to see a change in the direction of pricing, and therefore we will see, I'm sure, some further changing in pricing at 1.1. I think more importantly, though, is the opportunity being used by clients and brokers to extend terms and conditions. And this is somewhat more dangerous in some senses because pricing is more simplistic to understand, but it's in nature of understanding the type of risks that you're adding into your coverage, understanding the exposures, which, again, Stephen alluded to in relation to internet and the cyber risks. Just these add-on covers are always quite dangerous at a difficult time in the market. The market is littered with stories of people adding in that extra cover, and that being the event that causes the loss and causes the change. So I would just express some concern that we will see a pressure on non-standard terms and conditions, hours clauses, etc. Yes, of course, we'll start to see pressure on that. But in the non-standard words of cyber losses, terrorism, and other add-ons, that's the more concerning change for me than pure pricing, where we can make our choices as to whether the pricing is sufficient or not for us to continue on a risk.
Thanks. And Costas, from your perspective, do you think that the market is being rational in terms of pricing, whether it's terms and condition or pricing, or there is some irrational behavior when it comes to pricing going forward directionally?
Well, I don't see much irrational behavior. It all depends what your expectation is. What you currently see, especially in the catastrophe reinsurance, and we tend to focus a lot on what goes in the cat area because it's such an important part of the reinsurance market, especially on this island. What you see right now is you see a class of investors that are prepared to take the risk on at lower returns, period. And if a product is commoditized, if it's sold as a bond, you tend to compare to a high yield product, and lo and behold, so a 6 or 7% return appears attractive, where exactly the same product done as in an equity form, we've been used to getting double-digit returns, and low double-digit returns were not enough. So what you see right now, it's not irrational behavior, it's a behavior from investors that are prepared to live with a lower return. Is the differential between the equity product that is expected to have a better return and the bond irrational? In a way it is. But what you don't see, and I think it will be an interesting test whether we will see it, is products being priced at an expected loss. I have not seen this anywhere, and when you see pressure to move close to that level, the market is pushing back. As Jeremy said, sort of in June and July, you did see some things that did not get done because there wasn't enough margin of it. And I also tend to agree with Jeremy that some of the pressure that we may see in pricing may come in by stealth, by expanding terms and conditions, things where you cannot price using models and rely a little bit more on gut, and it's easier to ignore or take a little bit too rosy a view of what the price of risk is.
Thanks. Arthur, we've been hearing a lot about the influx of third-party capital coming to the reinsurance market. What is your view in terms of its impact on the reinsurance industry? Is it positive, neutral, or negative?
I might respond slightly differently than to rate it in that way. I think what it suggests, though, is that the market is evolving and innovating. I think whenever you have a closure of the gap of information asymmetry which has existed in our marketplace, and investors can better understand a different marketplace that they choose to invest in, then it naturally tightens their ability to access. And I think once the capital markets come in, there's a natural gravitation towards a somewhat more efficient marketplace. Whether it's positive or negative, I'm not going to comment. It's certainly having some structural changes on the market. It's certainly introducing a lot more capital into the market, which is, again, causing some potentially permanent changes. I think I'm always a glass half full guy. I look at this somewhat more optimistically in that I think there's been a period of quite deep innovation that's particularly happened in the Bermuda market over the last 12 to 36 months, and I think that can only be a good thing for the industry as a whole.
Thanks. And Jeremy, from your perspective, what is your view on this influx of third-party capital?
Well, I welcome it. We have a skilled underwriting and modeling team that is available to work for other capacity. I mean, we were just stated out of a Lloyd's business, which started by writing on behalf of third-party capital. That is our history. We still operate in London with a substantial amount of name support because they buy and sell our capacity at a level we're not prepared to buy them out from. And we also have a significant part of third-party capital supporting our traditional underwriting with our quota share partners. So that's part of our history. So it's about making sure that we utilize our sales force to operate on behalf of whatever capacity we have. And if we see an increasing level of capacity and capital coming to the market, we're very happy to serve it through that team. And we are, as I said earlier, building out our own vehicles to manage this capacity. What, however, looking at pricing has been interesting is that we've gone out, we have a very clear view on the level of risk through our modeling team. We built our own Hiscox view of risk. We use the models, but we also build our own model from that. It's a conservative view of risk, more conservative maybe than many people utilize in the marketplace, but it stood us well because we want to be here, not just in 10, but not only 20, but in 100 years' time, still managing risk on behalf of third parties. But what's been interesting to see as we've walked around investors and seen competitors' products, that we go in on a mean loss basis, that we see that people are selling a product based on the out-of-the-box model with a no-loss scenario, and we think that that is somewhat naive in the way that's presented. And I think certain of the aggregations that we see on some of the products are slightly dangerous. So I don't think we've got naive capital because I think they're very, very experienced investors coming into this marketplace. Perhaps they just are a little bit inexperienced in the reinsurance world. And perhaps because of the benign conditions and the returns we've seen, they haven't yet been fully tested. And I think we've got to go through that period. I don't think it'll put everybody off, but I certainly think it will be a realization that there is, in my view, alpha in underwriting in this marketplace. And I think we're dealing with investors who are used to generally believing that beta is the right way to go, but I strongly believe there is a huge outperformance that can be achieved by a good underwriting team using a good model of risk, and that ultimately when we see losses, that's when you'll see good performance. And we haven't been tested in that way for some time, and as a result, we've lost that perspective as to what is the true cost of this product and what is the true pricing. And we're in the danger zone at this time.
Thank you. And Don, from your perspective, this third-party capital, is it a good thing for the market?
It's just the development of the market. It's done because of low interest rates. It actually, if you look at the last quarter or so, some of the third-party capital is actually underperformed. You follow the stocks of several publicly traded hedge funds, and you'll find that their change in book value has been flat to negative, where most of the companies through year-end have had increase in book value per share. Greenline, for example, had an actual loss for the quarter, whereas none of the reinsurance companies that we follow that are here in Bermuda have had a loss for the quarter. They had different results, some better, some worse, and that's just a question of management and ability. Bermuda also, just as a side event, looking at the population here, Bermuda really still is the center of the reinsurance market. It came here in '93 following Hurricane Andrew. And I'll never forget because we started our company then, and a member of Lloyd's said to me, he says, "Oh, you guys, Bermuda, you'll have one hurricane and you'll be gone." Today, he's the chief executive of a Bermuda company. It is amazing. Bermuda, of the United States, outward reinsurance internationally is about $65 billion as of 2013. Of that amount, More than 50% is Bermuda. The next largest market is 14 billion. So it gives you an idea. Bermuda is still the dominant place.
Thanks. And Costas, do you agree with the sentiment? Nobody wants to give, in terms of whether this third-party capital is a positive or a negative, or in terms of reinsurance company, should they embrace this third-party capital and becomes part of their strategy going forward, or is it just, business as usual?
It's a reality. And it's an evolution of the market. Whether it's positive or negative depends on what you make out of it. We talk, ultimately, as reinsurers, we have a set of skills, which is understanding, accessing, and assessing risk. How we finance ourselves will change, has changed over time, and will change going forward. And what we make out of this third-party capital is down to us, how we'll best exploit our skills to make a return. Great.
In terms of return on equity, historically, when we've been talking to industry players, they target a 15% ROE throughout the cycle, or a certain number of basis points over a risk-free rate. But it seems that the industry has failed to, let's say, get those returns over the last few years, understandably for the obvious reasons. However, in terms prospectively, whether it's for 2014 or 15, what type of expectations should we have for the industry? Probably start with Costas.
Well, I would challenge you to give me an industry that over 30 years have achieved 15%. I mean, 15% return compounded, it adds up to a very, very big number over 20 years, which is roughly a full cycle. You'll get a huge number in book value growth if you're able to compound on average 15% per annum. And 15% is perfectly feasible and easy to beat in good markets, but also on the soft phase of the cycle, it's very high. The other point is you have to look. You can't take returns at an absolute level, ignoring economic conditions. Where if you look at returns over a period when risk-free interest rates, mid to long-term interest rates were 5% and 6%, yes, a double-digit return is not that hard to achieve. If coupled to that, if that period you could have a much higher leverage models, it's much easier to achieve. Now, when you look at 10-year rates and there's a 2-handle, and when you look at leverage models that are below 1, then achieving a double-digit return or on a sustainable basis across long periods will be a very good, exceptional performance.
Thanks. Jeremy, what is your expectation for the industry?
Well, look, it has been a pretty good long run for the reinsurance industry for quite a long period of time, notwithstanding a couple of years where we've seen some big loss events. So it's been a fantastic period, maybe an unreal period, and it's really quite understandable as a result of that. Other people want to join the party. So returns clearly will be down because of the broader economic challenges, the interest rate environment, of course. And yes, we will internally be looking at a lower return on equity for our business. We don't publish what that would be, but we're very careful to manage down our risk appetite and manage our returns. But clearly they will be lower, and that's why we will move capital to other areas of the business as appropriate.
Thanks. And Don?
It's hard to come up with numbers, but if 15% were roughly the returns, we're running now probably around 9%. And again, you'll never have the 9%. It'll either be 13% one year and -3% the other, but I think we have had a substantial decline, but it's everywhere else as well. I mean, if you bought junk bonds, you took risk of default, and you were getting junk bonds at a 6%, 8%, 12%, 14% return, and now junk bonds, you see them at 5 and 6 because they're 500, 600 points over treasuries. So I think we've had a decline, and I've used 9, but it's meaningless because we'll never get it. It's either going to be greater or less.
Arthur, in terms of your interaction with your clients here on the island, what are you hearing in terms of what they're targeting prospectively in terms of return on equity?
Well, I tend to agree with the panel that 15% is entirely unrealistic. I would say that the Bermuda peers have managed capital very effectively over the years, and that's one of their skills. And certainly when you look at where we are in the underwriting cycle, if they can't deploy capital effectively in profitable lines in different parts of their organization, then they seek to return it. And I think that's a great strength of an organization to be able to do that in a very disciplined fashion. So I'm not going to comment on what the expectation is on ROE, but I think that's a facet of this marketplace that's particularly strong.
Thanks.
But just one comment. 15% in a 6% money market and 9% in a 2% money market on a relative basis, the relative value hasn't changed.
Yeah, thanks. And now we'll turn around to the audience and see if they have any questions that the panelists can address. Please raise your hand and we'll give you a microphone. All right, I don't see any questions for now. So I'll turn back to my panelists and ask you a question about probably what everybody is on their mind in terms of mergers and acquisitions prospectively. It seems that stock prices have come back, and most of the Bermudians have traded either around book value or at premium of book value. So from your perspective, for the next 12 to 24 months, you think we'll see some increase in M&A activity on the island? Jeremy?
Well, look, I can sit here and comment as an innocent bystander because, we're a diversified group. We, I think, make no bones about the fact that we're not great fans of mergers and acquisitions. We like to grow incrementally, and that's been our style. And so I'm not sitting here, I think, giving the game away that we haven't got a long list of targets that we're out there looking at. So looking at it as an observer, if you specifically look at the reinsurance market, I don't quite see, from my perspective, what the value is of going out and acquiring when returns are still pretty good because of the benign conditions we've had, spending a lot of money acquiring another team in an area under pressure. Yes, we talk about opportunity, but there is pressure, and therefore putting two teams together and spending that money, I don't think in the reinsurance arena is necessarily a good area. I'm reminded of an analogy a banker once gave to me in my prior career of saying it's like two drunks propping themselves up. They look good for a while, but subsequently they both fall down. And, I would worry about that. So where do I see the pressure? I see the pressure more in the moves you see of reinsurance organizations who've made substantial returns, being able to either return that to capital in the Lancashire model or perhaps move into the more retail space as we've seen in the Validus model. All I always congratulate our group on is having used what has been a fantastic ride for 15 years of using the really great returns we've had to build a retail business, which provides some stability for the group. And that's something that I bless every day that they've managed to achieve on behalf of our group, because it gives us choices when we don't like any risk, but enables us to drive forward when we want to.
Great, thanks. And Costas, from your perspective, should we expect a consolidation of the Bermudians?
I'm not going to make a prediction because I'm going to get it wrong. The only thing I would say, price is one dimension. There are a lot of other things that come into play, social factors, integration risk, more importantly, strategic business logic, and you have to take all of that into account. It's not just about price. And the challenge in the industry right now is we have an excess capital. We're in an excess capital situation. But companies, as Arthur said, have been pretty good in returning capital. So you don't need to see a consolidation to see capital exit in the industry. Could we be more efficient? Would the market be more efficient if there were fewer companies? Yes. be some expenses that go out. But in the overall scheme of things, that's a relatively small factor.
Thanks. Don, do you have any?
Yeah, I don't see consolidation. I mean, you saw the Endurance Aspen deal or opportunity never come to pass. I don't see any. You'll always see deals. I mean, that's just part of the business. But I don't see a consolidation necessary at this point.
Great. I'll turn back again to the audience just to give you a last chance to ask any questions you might have for our panelists. Please raise your hands if you have a question. It seems that our audience is somewhat quiet this morning. So going back to the panelists, in terms of over the last few years, we've seen the emergence of hedge fund reinsurance companies, which is the subject of our next panel. But I wanted to get your views in terms of how successful is this model and how it will, carve out a niche within the reinsurance market. Maybe I'll start with you, Jeremy.
Well, thanks. John Berger's just walked into the room. What am I meant to say? Look, it's a very interesting model. It's another example of where capital is moving from the pure reinsurance play into the insurance market. It is another part of the cycle and trend, we're going to say. And I'll duck a little bit by saying I think the jury is still out because we are beginning of that cycle, and it's a new play, and therefore we haven't see it play out. From our perspective at Hiscox, we did look long and hard post the Watford Re deal. We were pressed by a number of parties to look at some form of vehicle. For us personally, not to challenge the vehicle, I think the issues that we have, we spent years trying to train our underwriters to bring in business at 80, 85% combined ratio, trying to drive good business through our organization. And therefore, trying to drive further business for a vehicle that is prepared to accept business at higher combined ratio is something that we would find, I think, very countercultural. And if we can continue to find business with the 80, 85% combined ratio, then frankly, we're going to eat as much of it we can ourselves. I'm not going to give that to third parties. So I think from an underwriting perspective, we found it very difficult to get our heads around the concept that it would be suitable for us in Hiscox. And secondly, I think coming from our Lloyd's background, of course, caution on our invested assets is inculcated in the organization, and therefore to try and push the envelope on both sides doesn't to us feel in line with our long-term strategy to be here in 10, 25 and 100 years, as I said earlier. So we find it difficult, but do I think that we will stay out of the game? No, I think that through our ILS arms, through our ability to service capital, we will look at vehicles of this kind at some stage and may well come out with our own in due course. That's not a prophecy. There's nothing currently on the stocks, but we get approached a lot of times, and for the right deal, we would be prepared to facilitate something of that kind. But fundamentally, is it a business model that I see that is right for our business? No. I think there are some of the challenges on the inwards and outwards on the investment side that we would find too difficult for our own business.
Thanks. And Costas, from your perspective, what are your views on this new model?
Again, I don't think there's one. You can lump too many things into one pot and call it a hedge fund models. There's different flavors of hedge fund participation in our industry. But if I stay on one side of the spectrum and take the model where there is relatively a small amount of insurance stroke reinsurance risk and relatively large amount of investment risk in an insurance reinsurance wrap, is that the shape of thing to come? I can see three reasons why a hedge fund may want to have such a structure. The first is a permanent capital base. If you have an entity, and particularly a listed entity that through which you can invest, that has certain advantage in terms of withdrawals, and so you can take a different view on the or different horizon on the term of your on the investment side. Second is there is some diversification, and for certain hedge fund strategies, having some insurance risk in an overall portfolio may make some sense. And third, and particularly important, and perhaps driving some of the things that you've seen in the past, there's an arbitrage, a tax and a regulatory arbitrage. And on that third one, I think the jury is out. I think there's a lot of noise about some of these things that have happened, and I think you'll see things evolve. So predicting on where this goes is predicated on what reaction may be on a regulatory and tax.
Great. And Don, do you see if this business model will be successful?
I think Costas made some good points. Look, there are two parts to insurance management. One is underwriting, and the other is investing. And it's a question of where you put your focus. And it's where the industry has probably lagged behind has been on the investing side because they're taking risk. They've stayed in bonds. They've stayed in relatively secure investments. And with hedge funds, it's just the opposite. When I grew up with the hedge fund industry, way back in my childhood, the business, we had A.W. Jones, and they were long and short. And they outperformed everybody because when the market went down, they covered their shorts. When the market went up, they sold their longs. And that basically was the concept. Now, since that time, investment strategies have gotten much more sophisticated. Some use arbitrage of bonds, some use stock markets. And that's the investment strategies. And the other point that you made is when you buy into a hedge fund, you pay a high price for management, but all the income is ordinary income, and all the income is paid to you every year. You get a Q1 from the hedge fund that shows that all the trades made. You come to Bermuda and do it in a hedge fund here, hedge fund reinsurance company, and it's not taxable until you actually sell your shares. So that's the arbitrage you've talked about, and that's one that's valuable. We don't know how long that'll last. The U.S. government is getting very panicky about that.
Thanks. I would ask each of our panelists to give their outlooks on the reinsurance industry and over the next 12 months. But before I do so, let me give a last chance to the audience. If there's any question before I ask my last question to the panelists. A burning question. This is your last chance. I don't see any hands. All right, so I'll start with Arthur in terms of your outlook on the reinsurance for the next 12 months.
Sure, thank you. There's no doubt we're in a difficult period structurally and cyclically. But I also think this is forcing executives and other stakeholders in the industry to concentrate on both innovation and developing where the next wave of growth can come from. So where in the world can we identify risk to be transferred to these markets and create a satisfactory level of margin for companies. But it's also challenging executives to look at their operating models. What do they want to be? Is it scale? Do they need scale to be a long-term player? And at the end of the day, being a long-term strategic partner for cedents is fundamental here. So is it scale? Is it, as we've talked about, building out a richer investment strategy? These are some of the questions that I think are just so fundamental to focus on. And I know many companies are concentrating on just that very point. What do they want to be in the next 2 to 3 years, but then over the next decade?
Thank you. Costas, your outlook?
My outlook for the next year or two, I don't think there's anything groundbreaking here. And yes, it's a challenging market, but this is a market that will change, and we tend to get overexcited about the change that's about to come next year or the year after, and we always get it wrong. We overestimate the amount of change that's going to come in the next 2 years. But by the same token, we tend to underestimate the change that comes over the 10-year period. And changes happen gradually. It's piece by piece by piece, and we move in a different direction. And I'm sure we will move in a different direction, but the market conditions over next year or the year after are only a small part of this equation. It's a much longer-term process, and you have to take the longer-term view.
Great, thank you for that thought. Don?
Management has improved in this industry dramatically. The analytics, the ability to look at risk, the ability to manage risk has really improved dramatically. And what will happen, I mean, again, when we look at a 1 in 100, And is it next year or is it 90 years from now? Nobody can forecast that. So we remember in 90, 95, 96, we had very soft markets. We had record profits. Nothing happened. Last year, this is just the year we're in now, nothing's happened. But I see management so much better at managing risk and so much better at analytics. I think the industry will continue on. I'm not at all pessimistic.
Thank you for your outlook. Jeremy, you have the last word.
Well, change always brings uncertainty to some extent, but actually, personally, I rather like change because it gives you something to deal with. I'm not a very good steady state manager in my view, so I like the challenge. I think that from us as an organization, it's given us, with our clients, an opportunity to prove value through innovation, through client relationship, broker relationship, and product development. And I think it's an exciting period, and one in which the good underwriting teams will be able to show their worth and value, not only to the investors in the hedge fund industry, but also to our cedants. So I look forward to a challenging but very exciting time.
Well, thank you, and please join me in thanking the panelists.